You know what really happens when a technology everyone kind of dismissed as just some volatile financial experiment quietly scales up in the background? Well, you get exactly that number right there. 220 million. That is the staggering number of monthly active crypto addresses globally as of late 2024. It's a figure that has literally more than tripled since the end of 2023, and it serves as undeniable proof of this massive, quiet growth.
Welcome to This Explainer. Today, we're diving into the state of crypto in 2024, and our core narrative is what I really like to call the maturation story. We're going to look way beyond the noisy market hype cycles, ignore the price ticker distractions and flashy headlines, and see how blockchain technology has fundamentally matured and upgraded itself over the past year.
All right, here's our roadmap for today. Number 1, usage hitting all-time highs. 2, stablecoins finding product-market fit. 3, infrastructure driving down costs. 4, crypto meeting AI. And 5, the political impact of crypto.
Let's kick things off with Chapter 1, Usage Hits All-Time Highs, Beyond the Market Hype.
So, while market prices are always fluctuating, actual on-the-ground usage of blockchain networks is quietly hitting record-breaking levels. As you can see, global crypto adoption is closely mirroring the rapid adoption curve of the early internet. And get this, mobile wallet usage just hit a record high of 29 million monthly users. This growth is heavily driven by international adoption in places like Nigeria, India, and Argentina. These are countries experiencing real currency devaluation, where everyday people are actively seeking out functional financial alternatives.
Moving right along to Chapter 2, stablecoins find product-market fit, the so-called killer app.
For years, people have been debating blockchain's killer app. Well, it turns out it's the stablecoin, digital dollars functioning as everyday utility. And the contrast in cost is absolutely staggering. A traditional international wire transfer, that'll run you about $44. That could buy you a really nice dinner, just for the privilege of moving your own money. But sending that exact same value using a USDC stablecoin on a Layer 2 network, it costs less than 1 single cent. Sending money globally is now practically free on the blockchain, completely bypassing those exorbitant fees of traditional finance.
Now, a lot of folks out there still think of stablecoins as just a niche tool for crypto day traders, but the data tells a completely different story. In the second quarter of 2024 alone, stablecoin transaction volumes reached an astonishing $8.5 trillion. To put that into perspective, that is more than double Visa's $3.9 trillion volume over the exact same period. They've achieved staggering, undeniable scale.
And to further demystify their scale, just consider this. Stablecoins are now a top 20 holder of U.S. Treasury securities. Sitting at $92 billion, they are absorbing U.S. debt at a level that literally puts them ahead of major sovereign nations like Germany. It's just a fascinating dynamic where this brand new digital technology is actually fortifying the U.S. dollar's position globally.
Okay, let's look under the hood. In Chapter 3, Infrastructure drives down costs, the engine upgrades.
So, you might be wondering, how is all this ultra-cheap transacting even possible? Before we dive into the data, let's clearly define a crucial piece of this puzzle, a Layer 2 or L2. Simply put, these are secondary networks designed to operate right on top of a main blockchain. Their entire purpose is to vastly increase transaction capacity and drastically lower costs. I really want to emphasize this so we understand these aren't just abstract, overly technical concepts. They are vital efficiency upgrades that make the blockchain usable for everyday people. Take Ethereum's DePIN upgrade back in March 2024, for example. When that was implemented, Layer 2 fees absolutely plummeted. But here's the crazy part. As the costs dropped, the value locked on these networks actually went up. The network became exponentially more popular and drastically cheaper at exactly the same time. And because of upgrades like this, blockchains are now processing 50 times as many transactions per second as they did just 4 years ago.
We're seeing a very similar breakthrough with zero-knowledge proofs, or ZK proofs. Basically, this is a technology that lets you prove something is true without actually revealing the underlying data. The cost to verify these proofs is plummeting, while the value secured by them is skyrocketing. ZK technology is opening up entirely new pathways for developer innovation by driving down verification costs and unlocking massive scaling and privacy potential. The foundational engine of crypto has literally been entirely rebuilt for scale.
Let's move on to Chapter 4, Crypto meets Artificial Intelligence, New Frontiers.
With these highly matured, low-cost blockchains now in place, developers are turning to the intersection of two of 2024's absolute biggest tech trends, crypto and AI.
And the natural synergy here is undeniable. AI is facing some massive structural challenges, right? Things like trust, copyright issues, deepfakes, and this insane concentration of compute power by just a few massive tech corporations. The sheer irony here is that AI's biggest problems, these exact centralization issues, are precisely what decentralized blockchains were originally built to fix. So let's walk through exactly how crypto networks can step in and solve these AI challenges. First up, democratization. Crypto networks can democratize access to computing power, letting anyone contribute to AI training pools. Second, tracking IP. Blockchains can ensure creators are actually compensated when their data is used to train a model. Third, transparency. They allow for the running of open-source user-owned models rather than hidden corporate black boxes. And finally, authenticity. Blockchains can instantly verify the provenance of digital media to combat deepfakes. This really provides that crucial so what factor for why these two technologies are merging so perfectly.
Which brings us to our final chapter, number 5, the political impact of crypto, real-world regulation.
With hundreds of millions of users and trillions in volume, crypto has naturally been forced out of the internet fringes and squarely into the real-world geopolitical and regulatory arena. Just look at how 2024 has delivered a steady drumbeat of regulatory clarity worldwide. In March, Wyoming signed the DUNA Act, giving decentralized networks legal recognition. In May, the FIT21 Act passed the U.S. House with strong bipartisan support to provide structural frameworks. And in December, the European Union's comprehensive MiCA framework goes fully into effect. Regardless of your politics, the legal guardrails are rapidly and objectively being built on a global scale.
And this regulatory shift is deeply tied to voter interest. Neutral search data since 2020 shows that crucial U.S. swing states, like Pennsylvania and Wisconsin, have seen the 4th and 5th biggest jumps in crypto search interest over the last 4 years. This data clearly illustrates that crypto is no longer just some fringe hobby. It is an economic topic of high interest to everyday voters.
Which brings us to our final slide, and a provocative thought I really want to leave you with today. Has crypto entered its 5th wave of innovation? Looking at the robust data we've explored, the record-breaking 220 million users, the explosive stablecoin utility, the massive infrastructure cost reductions, and the real-world regulatory momentum, it challenges us to consider if the industry is quietly on the verge of its next massive breakout. The fundamental building blocks have honestly never been stronger. Thank you so much for joining me for this explainer. I really hope these slides helped cut through all the noise and showed you exactly what is really happening under the hood.